Next, we'll hear from Ms. Kacaba. You are recognized for 5 minutes for your oral remarks.
Chairwoman Wagner, Ranking Member Sherman, and members of the subcommittee, thank you for the opportunity to testify before you today. My name is Rebecca Kacaba. I am CEO and co-founder of DealMaker, the leading platform in online capital formation. To date, DealMaker has facilitated over $2 billion in capital raised for over 900 American companies, creating up to 40,000 new jobs. I come from a family of entrepreneurs and am a former practicing attorney, having spent over a decade in private practice in the capital markets. The team at DealMaker have the distinct honor of working with founders building businesses they love. We see firsthand the difficulties of the entrepreneur's journey and how much they and their families sacrifice to grow a business and create jobs in America. We know the founder who slept on the storeroom floor for a year until he could get his business funded. We know the founders who stake their personal relationships and reputations, raising money from friends, family, and colleagues in order to get the idea they believe in off the ground. The very hope, vision, and purpose of our founders is why we do what we do. This is the essence of the American dream and what drives job creation. Every day, our team is privileged to serve these founders in the most fundamental way possible, and we take this responsibility seriously. We do this by implementing Congress's pioneering vision of the Jobs Act itself. In the spirit of this vision, we submit 3 proposals designed to ignite economic growth and create new American jobs. The first proposal is to remove the offering caps that inhibit growth and interfere with job creation. Reg A is capped at $75 million. At DealMaker, we regularly see companies who could raise more than $75 million. We ask Congress to remove the offering cap altogether. In the modern internet era, a cap on Reg A officially constrains growth. Because of the cap, companies are using alternative structures like donations, tokens, or institutional funding. Removing the Reg A maximum creates a pathway to bringing unregulated capital formation activities into a regulated space. To grow the space, we need to change the perception that only small companies can use the exemption. Reg CF is currently capped at $5 million, which should be increased to $10 million. The 2020 increase in the Reg CF cap from 1.25 to 5 million stimulated market activity by 250%. The Reg CF ecosystem is maturing with a growing prevalence of broker-dealer participation as opposed to just funding portals. Companies are regularly reaching the $5 million cap on Reg CF offerings. When companies hit this maximum, they face 2 suboptimal choices: either return to traditional funding sources or prematurely transition to a more costly Reg A. Our second proposal is to harmonize the Reg CF and Reg A regimes. Today, Reg CF and Reg A exemptions are being used for similar purposes. Investors are investing in both types of offerings interchangeably. Accordingly, the rules between the two should be harmonized. The best elements of each regime can be combined and shared. This would be easier for businesses, investors, and market participants to understand and lead to better compliance. 3 places where harmonization would remove significant friction are Rule 12G, Rule 5110, and the marketing rules. We have cited a number of the bills tabled where these harmonizations can be addressed. Finally, the third proposal is to expand the availability of Reg CF and Reg A to more participants to grow the space and create more jobs. Currently, Reg CF restricts the amount of money companies under common control can raise. This restriction differentiates Reg CF from traditional capital raising mechanisms and Reg A, which do not have such limitations. If the common control prohibitions are removed, it would allow more VC-backed companies to enter the space. This would capitalize more mature funded businesses and could also increase the survival rate of venture-backed businesses. In conclusion, let's reflect on how far we've come. Since Congress enacted the Jobs Act in 2012, Reg A and Reg CF have raised $3.7 billion. Reg CF has outpaced venture capital growth by 4.4x as compared to 1.3x. The capital markets have been diversified as Congress intended to weather economic down market conditions. During the worst year of the recent down market cycle in 2023, the online capital markets stayed over 40% stronger than the VC markets. Companies we supported survived and thrived when no one thought it would be possible. By increasing the offering limits, harmonizing the rules, and allowing for more capital markets participation in the space, Congress will unlock even more growth in online capital markets, leading to further job creation. The work that Congress is doing is critical and core to the job creation ethos of America. As a result of your work, we have the privilege of seeing firsthand our customers' factories in new communities that are overlooked by Silicon Valley and Wall Street, and the pride that it brings them. We are grateful for the opportunity to be a part of this hearing.
Thank you, Ms. Kacaba.
Can you talk a little bit about crowdfunding? I mean, it's been around for a little while, but with technology and easier access, and could you talk a little bit about where crowdfunding is playing in capital formation in today's markets and fundraising?
Yes, it's incredibly important, the technology that we've built at DealMaker and that a lot of our colleagues have built in the space is foundational to helping more entrepreneurs get funded. In today's day and age, we can do that, especially for jurisdictions that aren't Silicon Valley or Wall Street, by getting deals like Mr. Andrew Barnell's in front of people in all different regions. And so we can draw from the communities and we can help form businesses that aren't based in those city centers.
And what about investor protection through that avenue? What are some of your thoughts on that? Is there enough protection? Is there enough information disclosed?
The legislation is incredibly well designed. We have the Form C, we have the 1A. What we've actually seen is that with that standardized disclosure, more junior investors can become more sophisticated because every deal they look at, there's the same format where they can read the same information. And it's actually desirable that the whole exempt markets move in that direction.
Yeah, okay.
The Jobs Act directed the creation of regulation crowdfunding to build on crowdfunding as a new and innovative way for startups and small businesses to raise capital, typically over the internet. The number and size of regulation crowdfunding offerings has continued to increase over time. Noticed with this hearing is proposed legislation from my colleagues, including Rep. Measure that seeks to build on that success. Ms. Kacaba, I know you touched on this briefly about the benefits, but how would enhancements to regulation crowdfunding help small businesses raise capital? Would it be beneficial to expand the number and range of investors that can participate in crowdfunding offerings? And are there additional enhancements that you believe we should make to improve the utility of it?
Yes, absolutely, and thank you for the question. I agree with what you said. The Jobs Act, since its inception, has helped so many small businesses form and so many jobs be created. There are very simple, small adjustments that we can make so that the online crowdfunding space can flourish to allow more growth and more jobs to get funded. And those are in our written statement that we advocate for. The HALOST Act is an incredible step in that direction.
Appreciate it. I think from the standpoint of additional enhancements, Ms. Kacaba, what would you say are the necessary steps?
I think it's important to remember that non-accredited investors are looking to build wealth. And studies show that younger generations don't believe they're going to build their wealth from their direct jobs. They're looking for other ways in the gig economy, and they're looking to make investments. And so if you regulate them out of a space where we're doing bad actor checks, we're doing background checks, we're doing disclosure documents, you're just forcing them to put their money into other sectors like crypto, like NFTs, like the public markets, and there are no caps in those spaces. Under the Jobs Act, there's a cap in how much they can invest in every single offering. And so the Jobs Act is well designed that way. If we remove the cap on Reg A, we can grow the space, we can grow online offerings, and we can grow the ecosystem and communities of people that want to invest in businesses they love. We have a customer monogram. It was started by 2 doctors. They saw the need for a robotic knee replacement surgery arm. VC wasn't interested in funding that business, but there's a lot of people out there that know someone that's had knee surgery that thought that was a really interesting business. Now that company is public on NASDAQ. So if we can grow the online capital formation space by increasing the caps and streamlining the way Reg A and Reg CF work together, we can get more businesses funded.
Appreciate it.
Do you believe rural investors can be just as sophisticated as urban investors and should be allowed to more freely participate in private markets?
Absolutely, yes, and thank you for the question. I think that's a really important point. They are looking to generate wealth creation. The rules that we have in front of us already prevent them from investing too much in any one offering. So the rules are properly structured for them already, and we need to realize that if we don't let them into the private markets, their money is going to go elsewhere. And the private markets are well regulated, so they should be allowed to participate.
Thank you. Can you maybe elaborate on or discuss how the current accredited investor standard unfairly denies rural investors growth in their retirement accounts like a normal hardworking Montanan?
Yes, because they're limited in the offerings that they can get access to. Even some of the changes that we've advocated for, removing common control, would allow them access to investment in VC companies. For example, there might be a VC with a portfolio of 10 companies and they want to do follow-on investment in one. 9 of those companies are excellent companies. They don't hit a 50% growth rate that a VC requires for follow-on investment, but maybe they're doing 35%, and lots of people in Montana could invest in that and make a good bit of money.
Awesome. Well, thank you. I've run out of time, but thank you for your responses.
Kacaba.
Yes.
Go ahead.
Yes, I think the points you're raising are incredibly important. There are so many companies, like Mr. Cromwell highlighted, that DealMaker backs and funds in rural jurisdictions. And the written submission that we've submitted is just to get some of the regulations out of the way so that we can do more. And if there are different nuances made, if the caps are improved, if 5110 is removed, there are different ways that we can get more entrepreneurs funded, more jobs created.